of chatter on Wall Street and in financial newspapers about this coronavirus from Wuhan, China. And coming into October, the market largely forgot about this coronavirus. It didn't seem like it was going to be anything that would affect us. And now that's me speaking as the market. I'm sure many of you that are on the webinar, if you're in the medical field or just had a different perception, you might have been more concerned about this than the stock market. But the market at the time of early February was not that concerned. So the market rebounds, hits another yearly high in February at 29,551. And by March 23rd, the market tumbled all the way to almost 18,000. Part of what happened was not only the coronavirus economy shutting down, but also Russia and oil were having Russia and Saudi Arabia were having a disagreement about oil. So while they should have been cutting production because demand has been falling, they were increasing production, trying to kind of playing chicken with each other. So now you have coronavirus fears, the economy is slowing, people are using less oil, countries that are increasing their production of oil and oil prices tanking. Now, why would that affect, say, Main Street, or how does that affect the economy overall? Number one is a large chunk of the Southwest, their economy basically runs on oil. That oil producers are a big factor in the economy of the Southwest. And then also major banks like JP Morgan and Bank of America had up to 10% of their loans that they made out to businesses to the energy sector, specifically oil. So not only is oil affecting just the oil companies, but now it's also affecting our largest banks, and that definitely could reverberate to the economy. So what happened now? It was, I believe, March 23rd. The market is just in a free fall. It hits almost 18,000, and then the next day, stimulus is released. Markets start skyrocketing. They certainly haven't hit where we've been. They didn't hit highs again, but they came out of this real downward path and started back on an upward trajectory. Eventually evening out, dropping, and coming back up. But this stimulus was absolutely huge. It's my personal belief that if we didn't have the stimulus, the market could have kept going into a free fall. But to give you an example, when I talk about the market, I'm really talking about the stock market, but everything that's happened has also affected the bond market. So during that time, I was speaking to my bond trader that I work with at TD Ameritrade Institutional, and he was saying that he was able to secure somebody a Berkshire Hathaway 9-month bond yielding 9%. If you don't know Berkshire Hathaway, that's the insurance company run by Warren Buffett, who's one of the most successful investors in the world. They're a stable company. They have tons of cash. And to give you an idea of the spread between the Berkshire Hathaway bond and the Treasury bond, which is a U.S. government bond, is 10-year Treasuries are paying 0.6%, and Berkshire Hathaway's bond at that point was paying 9% on a short-term bond. So if you were to go in the market today and try to buy that same Berkshire Hathaway bond, you'd be getting less than 2%. So in a short period of time, the market froze up. People that were trying to sell bonds were not getting really fair prices, and people who were buying the bonds were getting great deals, in my opinion. So the first step, and this is my understanding of everything that happened. Everything's not perfect the way I'm saying it, but the first step is that the Fed came in with a bond buying program. So they brought a ton of liquidity into the market. They pushed it into the market. So these bonds, like this Berkshire Hathaway, were no longer taking this huge hit. So that liquidity, they were buying bonds. They made a deal with BlackRock to buy bond ETFs. So now the government's going in and buying assets so that the prices don't keep falling. And then the second leg is a $2 trillion stimulus package. Now, you may have heard about it or read about it, but this is the package that included airlines. $350 billion of it was allocated to small businesses. So if you're in a small business or you work for a small business, you may have gotten some of this loan money. You may not have. It's my personal experience and understanding that the funds were actually very hard to get unless you had a relationship with a banker. But that's a whole other side conversation. But so $350 billion was given to small businesses, total economic stimulus package of over $2 trillion, which also, I believe that package included the $1,200 check to anybody receiving the personal stimulus, up to $1,200, depending on your income. So a lot of money was pushed out into the market. As of April 16th, the $350 billion for small businesses has already been accounted for. So it's my understanding that Congress is pushing through another stimulus to add more money to this $350 billion. So more small businesses will hopefully have access to these funds. All right, so what can you do? Definitely don't cry. There's a couple strategies that you may be able to use during this time. And again, I can't give personalized investment advice, but I can talk about general strategies, but my information will be at the end if you have questions for me. One of the strategies is what I would say would be a simple strategy called tax loss harvesting. So if you bought Apple at $330 a share, and now Apple is $270 a share, you can sell your Apple stock and take a tax loss. Now you have to wait a month before you buy Apple stock back. So if you want to buy it back, hopefully it's $270 a share and it didn't jump. But that's the idea, is you could sell a stock, take a tax loss, and then wait a month to rebuy it. In my business, we deal mostly with funds, not stocks. So we would sell a fund and then buy another fund. Now the fund cannot be considered like kind because you will not get the tax loss. But if I were to sell a U.S. large value fund, which includes mostly companies like Johnson & Johnson, Coca-Cola, GM, more older companies that are paying a dividend, I could maybe buy then I could definitely buy a U.S. growth fund, which should be holding like Amazon, Apple, Netflix, the top tech names. So you can't buy like for like, but you could sell one U.S. stock fund to buy another U.S. stock fund and take your loss and still have exposure to the market. Also, another strategy that we use, which again, I would consider this to be pretty simple, although I might be spinning your head right now, is rebalancing. And rebalancing just means if you felt your comfortable place was owning half stocks and half cash or half bonds. So now you say you had $10,000 in cash and $10,000 in stocks, and now the stocks have gone down and you only have $8,000 in stocks. In our business, we would say, well, it's time to take $1,000 of your cash and invest it into the stocks so that you have that equilibrium again. Half stocks, half cash. In our business, it's mostly half stocks, half bonds. But this certainly could be an opportunity to look at rebalancing the portfolio, or if the portfolio wasn't performing well, maybe you had overweight exposure to international or emerging markets. Maybe this might be an opportunity to jump back into the U.S. markets if you think U.S. markets are going to do better. All right, so for first timers, so if you haven't invested and you maybe know a little bit about investing, I have my red, those are warnings, and green are my positive talking points. So first in red, buying into the market with hopes of short-term gains is, the technical term is speculation, but I'll call it gambling. And volatility is very high, which means that you can make money or lose money very quickly. So as I mentioned before about volatility is measured by the distance from the mean. So now you're making an investment and we don't know where you make the investment, but maybe you made the investment here, but the market's very volatile. It's going up and down. So in 1 month or 2 months, you may sell the investment here, but you may also be selling your investment here. So over the long period of time, if you're investing in a volatile market or in a volatile asset, over long periods of time, we hope that trend is moving up. And if you hold that investment for 4 or 5, 10 years, we would hope that you've actually made money and the investment has gone up. But the shorter amount of time that you invest, the more risk that you're taking, because there's really no way of knowing that it's going to be up or down. And also, if this is a first time investing, you definitely want to consider developing a financial plan. Now, financial advisors like myself, the reason people hire us is so we can either help with a financial plan or choose the investments for you. But there's also a ton of tools, either free or close to free. There's robo-advisor services that will offer you free tools that you could use for planning, and you don't even have to invest with them. Also, for many 401k providers, they now offer financial planning tools that you can use online. And I'm sure there's a number of free tools online. So developing a financial plan. And then the next three, these are very much generalizations, but I just wanted to give you an idea as a guideline. If you are single or married or in a committed relationship with no kids and no mortgage, consider having 3 to 6 months worth of savings or spending before making investments. For families, consider having more than 6 months worth of savings. And for retired investors, consider having up to 3 years worth of expenses. And I said savings or CDs. So if you're single, it's not always so easy to scrape together 3 or 6 months of rent and all the money that you need to live. But the idea is that you should have some type of safety money, because what we don't want is for someone to be a first-time investor. If you have $10,000, put $9,000 in the market, and then next month you need to take money out for rent, and now you've lost money. That would not be a great first experience. And as an advisor, I definitely wouldn't recommend somebody take their liquid assets. I would probably say, why don't you start with 100 or 200 a month rather than putting it all in one time in a very uncertain time. Also, too, these are, again, guidelines. If you lost a job or losing a job or have medical issues that you know about, you probably will want to have more cash on hand to weather a downturn. All right, and then some financial planning basics, and then I'm going to get into some products that you could think about. And I'm not selling products. This is to educate you. So if you're either talking to an advisor, a broker, a bank, or on your E-Trade account, or Robinhood, you'll have a little bit more of understanding of what's what. So financial planning basement, the first thing that you need to figure out is your current and future income needs. So your spending, and then your current and future expected income. So your earning. So you have to figure out kind of what's the money that's going to be coming out, and what money is coming in, and what money is going to be going out. And now earnings could be earnings from investment. It could be the sale of a business. It could be work. It could be Social Security, expected pension in the future, expected inheritance. It could be any number of items, but money that you'd expect to come in. One of the common terms that you'll hear from investment professionals is time horizon. And time horizon just means the amount of time that you have to invest. So if you're 30 and you're looking at retirement age at 65, your time horizon would be 35 years. If you're 65 and your life expectancy is 90, your time horizon would be 25 years. So if you're 30 and your life expectancy is 90, I would argue that your time horizon is 60 years. So if anybody on the webinar right now is 30, your time horizon could be 60 years, 40, it might be 50. A lot of my clients make the mistake of thinking that their time horizon is retirement age. But once you hit retirement, you still have a number of years to go. And if you're aware, I'll jump to financial education. If you understand investments and time value of money and inflation, also understand that inflation does eat away at your money. So if you retire and decide to put everything in cash, your chances of running out of money might be higher than if you invested, now depending on how much cash you have. Risk tolerance is another basic financial term. Risk tolerance just means your willingness to take risk and also your ability to take risk. So the person with $10,000 that wants to invest $9,000, you might have the willingness to take the risk, but the ability to take the risk, if you only have 10, you really shouldn't invest 9. So that affects your ability. All right, I'm just turning my timer off here because I'm almost done. And then this is something that I created. Again, it's not set in stone, but your least volatile to most volatile strategies. So cash would be your least volatile, especially if it's in your mattress. You can access it easily. You see it, it's there, even in the bank. And then the most volatile strategies, I would argue, would be directional options. So an option is not buying a stock or a fund, but you're making a bet what direction it's going to go. So that gets very volatile. So you could lose your money very quickly with options, and cash, you shouldn't lose your money at all. And I think this is my last talking point, is the cost of different strategies. So I'll let you read the low cost and high cost strategies yourself. But what I'd like to talk about is opportunity cost. So cash is a low cost strategy, but it has a very high opportunity cost. So if you're invested in cash and you could have bought a CD that earns 2% a year in interest, your opportunity cost would have been 2% a year. If you were invested in cash and the stock market went up 30%, you could have been in the market. Your opportunity costs would have been 30% by being in cash, not the market. And there are products available by banks and brokers called, say, an index CD. So an index CD is a product offered by the bank. It's FDIC insured. You can't lose principal. It's linked to a market like the Dow Jones or the S&P 500. But you can only earn so much. So you might only be able to earn 5%. So if the stock market goes up 10%, you could earn 5% a year, and you can't lose money because it's a CD. Now, you can only lose money if you sell it before maturity, but if you wait until it matures, you don't lose money. But again, the opportunity cost with something like an index CD is if the market goes up 10% a year and your CD is only allowed to go up 4% a year, you've missed out on 6% a year. Annuities have high fees. Some of them have structured, like the index CDs, some of them have up to 4% fees. So again, your opportunity cost of using an annuity versus an ETF or an index fund would be the fees that you're paying. And also with some robo-advisors like Charles Schwab Intelligent Portfolios, it's a free service, but they allocate a large amount of your money to cash because they collect the interest on the cash and give you very, very little interest. So that's something to think about, kind of beware of when you're making these decisions. All right, and the moral of the story is you want to have time in the market and not be timing the market. So if you started today and you went for 20 years investing, pretty good chance you'll have a good story to tell me at the end of 20 years. But if you did today and 20 days, it would be very unknown if that's going to work out or not. But I would argue that over a long period of time, the investments compound and they really have an opportunity to grow. And the basic principles of investing and financial planning from before the pandemic remain after the pandemic. So if you've lost a job, which may be the case, especially now, you might have a different approach to your investments. But if nothing's changed in your financial life, just because we have this situation doesn't mean that you should be changing all your investments. And then there's a number of products, as I mentioned, that you could be used to reach your financial goals. But the most important thing when it comes to investing, especially during a crazy time like now, is what are your financial goals, and invest based on your goals, not based on what you hear on TV or you see on the news about the stock market. You really should be investing based on your long-term goals, not your short-term fears. So I do want to thank you. I went about 2 or 3 minutes over. My information is here on the screen. If you have any questions you want to ask me in private, please feel free to reach out. I'm always happy to talk to Purchase Alum. And also, we're going to open up right now for questions. So if you would like to ask a question, please raise your hand. It'll be in the participant area and we'll unmute you.
David, I actually went ahead and unmuted everyone because there's just too many for me to track the hand raising so they can ask their questions.
Sure.
Hey, David, Evan Fisher here in Los Angeles. How you doing?
Hey, was that Evan?
Yes, it was.
Hey, Evan, how you doing?
Thank you again. Excellent presentation. Appreciate it much. One question, and since I'm kind of on the older portion of things, is the subject of long-term care insurance. A lot of criticisms. Now, in the last year or two, I've seen some kind of hybrid products in that category. So, can you hear me, David?
Yeah, I hear you. Yep.
Yeah, so the question is, what's your opinion on them? And particularly in the last year or two with some of these hybrid products that I guess minimize the risk side and guarantee you some level at least of what you invested into the long-term care.
I think the hybrid products were a necessity to come out because there's a lot of uncertainty. In New York, we had, I think, Genworth and MetLife. So regular long-term care products, premiums started going up rapidly.
Right.
And I think if you're healthy and you could afford one of these hybrid products, the one danger I would say is that you have to read into the paperwork to understand if you were to get sick and need long-term care, you have a doctor who's going to come out and see and say, okay, Evan needs long-term care, we're going to send you a check every month, or are you going to have to submit for reimbursements? That's something I've seen with the different products, which I would be aware of, is if you have to submit for reimbursements. And then the other hiccup with long-term care is that the time period from when it's like, I think it's 3 to 6 months that you have to before you actually start collecting. Unfortunately, it's my understanding that the insurance company is betting on you no longer being around in that time period. So if you're really in bad shape and it takes 6 months to start collecting checks, that's something to consider is what's the time period. I like the products, but you have to be pretty healthy and on the younger side of older to get a decent rate.
Right. Yep. Thank you. Appreciate that.
Yeah, definitely feel free to reach out to me too. I'm happy to talk more.
Okay. Thank you.
All right, I think we have everybody on unmute. So if anybody had questions, still have 20 participants, and I'm going to check my chat too.
Can I ask a question? I don't know if you can hear me.
I do hear you.
Hi, I'm very impressed with your progress after having graduated from SUNY Purchase and going. I too am an alum, but a while before you got there. So I'm very.
We lost you, or I lost you at least for a second there.
Host remuted me? Oh no.
Oh, sorry, there you go. You're back.
Yeah, just in case no one else notices, I don't know about your neighborhood right now, but there's some tempestuous weather out there. So it could be affecting our connectivity.
Yeah, it's raining up here, so.
Yeah, and very nasty here as well. So not to digress, I just wanted to congratulate you on having become so successful in such a short period of time. And I realize this is all relative, but financial services is an exceptionally difficult environment at any time, not the least of which is ours right now, number one. Number two, I'm looking forward to having a conversation with you at some point about the industry and your position in it, because I'm curious to hear more about your firm. But lastly, do you personally have long-term care insurance?
I do not personally, no.
Okay, because I think that the observation that was made about the hybrids was excellent, and I think the industry had no choice but to alter their perspectives on how best to manage the product and its relationship with their clients, because some of those constraints that you mentioned have been eased up a great deal by depending on your carrier. So thank you very much for an excellent presentation. And my name is Linda Travis, and I'm going to call you on the phone maybe tomorrow and just introduce myself and speak with you briefly on a couple of subjects.
Thank you.
Indeed, you're welcome.
I want to make on Linda's point too. I think, I know Purchase College was instrumental into my success where I'm at today. I came to Purchase from University of Miami, and I was not a great student there. And I wasn't even sure if I was going to finish school and graduate. And Purchase was just such a welcoming, open, warm place, but a place also where I felt very challenged in the economics department to learn more and to be more accountable, and really helped me with my professional development. So really big shout out to Purchase, because if it wasn't for Purchase College, I for sure would not be where I'm at today. And I also say about success to me is, there's a financial part which you could measure on paper, which is not the success that I see as being, part of my family, being able to help my parents out, especially during this time. My landlords, who are 80 years old, who we are able to do food shopping for. And I think success is more measured by our effect on other people and positive effects. So it's great to do these things and give back.
I couldn't agree more. And I believe that that's part of the Purchase gestalt that you come away with that others do not necessarily share. And for whatever your level of financial success, which of course is important in the world, that for those of us who have had a chance to compete in several arenas and find that the kind of thought processes and thinking skills that you get from Purchase, you don't get anywhere else. And you can always be a contender regardless, because it's just an unusual brand. Really and truly. So I'm going to step back out. Thank you.
All right. Thank you. All right. I have a question from Pedro. It's a typed question. David, could you provide some insights if you're an investor looking to leverage your portfolio for home purchase this year? What type of strategy should you focus on? That would be definitely a question I would tailor more in private. And when I say private, I don't mean that if you give me a call, I'm going to start a clock and you have to pay me. It's really one-on-one. I could talk to you, and I don't charge for that kind of service. I charge for investment management. So that question would be better in private without knowing your situation. I'm not sure that I could really answer it, but if you are invested and you don't want to pull out, a number of brokers, even the small brokers like Robinhood and TD Ameritrade, will offer you margin loans, so you can get a loan against your securities, and you could probably negotiate the rate, but you're looking at somewhere around 5%. So not as low as a mortgage, but a lot easier to get to than applying for a mortgage. Obviously, selling some of your investments to use that money to purchase a home would be another strategy. May not be a great time, but who knows with this market if it's a good time or bad time to sell, because it could go up or down 10 or 20% any week. And other for leveraging your portfolio, I would think that's if a lot of 401ks offer lending. We try to advise against taking on debt from investments to make any purchases, whether it's home or otherwise. So as an advisor, I generally would not recommend making a margin loan, or I would not recommend taking a loan against your 401k to use it for a down payment. That's just our philosophy, is we like less debt, because when things happen like today, you're not in a corner. So definitely, Pedro, if you have that question and you could tell me a little bit more about yourself, I'd be happy to talk to you more and figure out with you if there's any solutions. But we prefer less debt because you get into less trouble. And this last few weeks has been a good example of that.
It's true.
Do we have any other questions? All right, we have 17 participants. I'm just scrolling through to see. I had another note about long-term care. And all right. And I'll give it another minute or two. Anybody want to hear about oil? I mean, oil's crazy today.
Oh, please.
Just a quick note. I believe it was yesterday, if you had the storage capacity for oil, the barrels were negative $35 a barrel. So someone was paying you to store the oil and you weren't actually paying for the oil. So oil market went completely upside down on its head. As I mentioned before, it's just a classic.
I gotta say thank you.
Yeah, that's oil is, I mean, simply put, it is classic supply and demand. There's no demand right now, and there's a ton of supply, and there's also no storage. So a lot of the oil producers have nowhere to put their oil and no one's using it. So that's causing a lot of that. I don't want to ramble on. It looks like we're over time here. So Nadej, do you have any closing words or should we just close out?
Oh, sorry, my mic was muted. No, I think that was really a great presentation, David. Thank you so much for, presenting for us, for Purchase College and for the Purchase College Alumni Association.